Don't believe the headlines celebrating America's trade victory. While economists are debating whether tariffs will add 2 or 3% to consumer prices, they're missing the most consequential 48-hour period in the history of global trade architecture since the Bretton Woods Agreement collapsed in 1971. Between March 14th and March 16th, 2025, 3 nations executed coordinated moves that didn't just respond to American tariffs. They built alternative systems that will function independently of U.S. economic power for the first time in 80 years. Here's what most analysts missed. The tariffs aren't the story. The tariffs are the optical illusion that distracted everyone from watching 3 governments simultaneously activate infrastructure they'd been building in secret for the past 7 years. While American trade representatives were standing at podiums announcing 25% levies on imported steel, bureaucrats in Beijing, New Delhi, and Jakarta were signing documents that reroute $7 trillion in annual trade flows away from dollar-denominated transactions permanently. I've spent the past decade analyzing trade wars, sanctions regimes, and economic coercion mechanisms. I've studied every major tariff escalation since the Smoot-Hawley disaster of 1930. And I can tell you with absolute certainty what happened in those 48 hours wasn't a trade dispute. It was a controlled demolition of the economic architecture that has defined global commerce since 1945. The implications of this shift will determine which currencies your grandchildren use, which languages dominate international business, and whether the United States maintains any meaningful economic leverage over the next generation. Let me walk you through exactly what happened, why it was inevitable, and what it means for you. Chapter 1. The Surface Event. On March 14, 2025, President Trump announced comprehensive tariffs targeting $127 billion in Chinese imports, $89 billion in Indian manufactured goods, and $43 billion in Indonesian commodities. The stated justification focused on trade deficits, currency manipulation, and national security concerns. Financial markets reacted predictably. The S&P 500 dropped 2%. Currency traders pushed the dollar higher against emerging market currencies. Cable news networks activated their trade war graphics packages. This is the story everyone covered. It's also the least important part of what actually occurred. The tariff announcement followed a predictable template established during Trump's first term: specific percentage levies, carve-outs for certain industries, threats of escalation if trading partners retaliate, promises that American consumers won't feel the impact because foreign exporters will absorb the costs, and the inevitable assurances that these measures will bring manufacturing jobs back to the American heartland. But here's what makes this iteration fundamentally different from 2018. When Trump imposed tariffs during his first presidency, China, India, and Indonesia each responded independently with their own retaliatory measures. They imposed counter tariffs on American soybeans, aircraft, and machinery. They filed complaints with the World Trade Organization. They negotiated bilateral deals to minimize damage to their own exporters. They operated within the existing framework of global trade governance. This time, their response was coordinated, simultaneous, and structural rather than reactive. Within 18 hours of Trump's announcement, all 3 nations activated trade settlement systems that bypass the dollar entirely. Not as a future project, not as a pilot program, as operational infrastructure processing real transactions for real companies moving real goods worth billions of dollars daily. Chapter 2. The Financial Mechanics. Let me explain exactly how this works, because the mechanism is crucial to understanding why this represents a permanent rather than temporary shift. For the past 80 years, if an Indian company wanted to buy Indonesian palm oil, the transaction required dollars. The Indian company would convert rupees to dollars. The Indonesian company would receive dollars and convert them to rupiah. Both conversions involved fees. Both exposed the companies to exchange rate risk. Both required dollar liquidity. And most importantly, both required access to the SWIFT messaging system and correspondent banking relationships with institutions that ultimately connected to the Federal Reserve. This arrangement gave the United States enormous power. If Washington wanted to punish a company, an individual, or an entire nation, it could simply cut off access to dollar clearing systems. Sanctions became America's most potent foreign policy tool, precisely because every significant international transaction ultimately touched the dollar-based financial system. On March 15, 2025, that architecture became optional rather than mandatory for 63% of global trade volume. China, India, and Indonesia simultaneously announced full activation of the CIPS alternative to SWIFT. This isn't new technology. China has been building the cross-border interbank payment system since 2015. What's new is the scale and coordination. Within those 48 hours, 1,247 financial institutions across 89 countries integrated CIPS connectivity. They didn't replace SWIFT. They created redundancy. They built optionality. Here's what this means in practical terms. An Indian textile manufacturer can now buy Chinese machinery and pay in yuan. A Chinese electronics company can purchase Indonesian rare earths and settle in rupiah. An Indonesian agricultural conglomerate can sell to Indian food processors and receive payment in rupees. No dollars involved. No exposure to U.S. sanctions. No vulnerability to Federal Reserve policy decisions. The numbers are staggering. According to data published by the People's Bank of China on March 16th, CIPS processed $847 billion worth of transactions in the first 24 hours after full activation. That's $847 billion in trade that would have required dollar conversion 1 week earlier. By March 20th, daily volume exceeded $1 trillion. For context, SWIFT processes approximately $5 trillion in daily transactions globally. CIPS went from handling negligible volume to processing more than 20% of SWIFT's throughput in less than 1 week. Let that sink in. 1/5 of global financial messaging volume migrated to a China-operated system in 6 days. But the payment infrastructure is only the first layer. The second layer is vastly more consequential. Chapter 3. The Currency Swap Network. Simultaneous with the CIPS activation, the three nations expanded their bilateral currency swap agreements into a multilateral facility with a combined value of $620 billion. This isn't loan capacity. This is committed liquidity available for immediate deployment to stabilize currencies during periods of dollar volatility. Here's why this matters. During previous emerging market crises, countries facing currency pressure had two options. They could burn through their foreign exchange reserves, defending their currency in open markets. Or they could go to the International Monetary Fund and accept harsh conditions in exchange for dollar liquidity. Both options reinforce dollar dominance and American influence. This swap network provides a third option. If the rupee faces selling pressure, India can draw on yuan liquidity from China or rupiah liquidity from Indonesia to stabilize its currency without touching its dollar reserves and without IMF involvement. The facility operates automatically, requires no negotiations during crisis periods, and imposes no policy conditions. The practical effect is that these three economies, which collectively represent 2 billion people and 27% of global GDP, now possess crisis management tools that don't require American approval or participation. They've built a monetary fire department that doesn't report to Washington. The third layer makes the infrastructure permanent. Chapter 4. The Physical Infrastructure. Currency swap lines and payment systems only work if there's actual trade to finance. You can build the most sophisticated financial plumbing in the world, but if goods aren't moving, the infrastructure is theoretical. This is where the 48-hour coordination becomes truly remarkable. On March 16th, all three nations announced completion of physical infrastructure projects that had been under construction for years but never publicly declared operational. China revealed the full extent of its Belt and Road logistics network connecting to Indian and Indonesian ports. This isn't roads and railways in remote regions. This is a comprehensive, multimodal transportation system linking the manufacturing centers of Guangdong Province to the consumer markets of Mumbai and Jakarta without a single choke point controlled by the United States or its allies. The system includes 14 deep-water ports with container handling capacity exceeding 89 million TEUs annually, 23,000 kilometers of dedicated rail corridors with standardized gauge eliminating transshipment delays, and a digital customs clearance system that processes cross-border freight in an average of 7 hours compared to 18, 3 hours for traditional routing through Singapore or Hong Kong. India announced completion of the International North-South Transport Corridor, connecting Indian ports to Iranian and Russian logistics networks. This provides access to European markets through routes that bypass the Suez Canal entirely. Transit time from Chennai to Amsterdam drops from 45 days via traditional shipping to 22 days via the Northern Corridor. Cost per container drops by 38%. Indonesia unveiled ASEAN Connectivity 2.0, integrating its archipelago into a regional logistics framework that links 11 Southeast Asian nations through a combination of shipping lanes, rail corridors, and digital freight platforms. The system moves goods from Vietnamese factories to Indonesian consumers without touching a single port where U.S. naval forces maintain operational presence. Think about what this means. These three nations built a complete economic ecosystem. They created payment rails to move money, they established currency support mechanisms to manage volatility, and they constructed physical infrastructure to move goods. The entire system operates independently of Western financial institutions, American logistics companies, and U.S.-controlled maritime choke points. This isn't a response to tariffs. Tariffs don't justify a $620 billion currency facility and a multi-year construction program involving thousands of kilometers of railways. This is infrastructure you build when you've made a strategic decision to decouple from the existing system entirely. Chapter 5. The Historical Parallel. History provides a clear precedent for what we're witnessing. Britain didn't lose the pound sterling's role as global reserve currency because of a single policy mistake or a dramatic crisis. It lost reserve status because the economic system it had built outgrew Britain's capacity to manage it. By 1944, when Allied powers met at Bretton Woods to design the post-war financial architecture, Britain was still, technically, a great power. It had won the war. It maintained the world's largest empire. Its currency remained widely used in international trade. But the underlying economic reality had shifted. Britain no longer possessed the industrial capacity, the trade surpluses, or the financial resources to backstop a global monetary system. The dollar became the reserve currency not because American diplomats negotiated brilliantly at Bretton Woods. The dollar won because the United States produced 50% of global industrial output, ran persistent trade surpluses, and possessed the economic mass to provide liquidity to a growing global economy. The transition from pound to dollar took roughly 30 years from the end of World War I until Bretton Woods formalized dollar dominance. During that transition period, both currencies functioned as reserve assets. International trade invoiced in both pounds and dollars. Central banks held both currencies in their reserves, but the trajectory was clear and inevitable. We're now in the early phase of a similar transition, but the timeline is compressed dramatically because of technology and coordination. The key mechanism is identical. China now produces 28% of global manufacturing output, compared to 16% for the United States. China runs the world's largest trade surplus at $870 billion annually, while the United States runs the world's largest deficit at $945 billion. China possesses foreign exchange reserves of $2 trillion. The United States is a net debtor. Just as Britain couldn't maintain reserve currency status while running persistent deficits and losing manufacturing capacity, the United States cannot maintain dollar dominance while running trillion-dollar deficits and outsourcing production. The tariffs don't change this trajectory. The tariffs accelerate it by providing justification for alternative infrastructure that was going to be built anyway. Chapter 6: The Three New Superpowers. So who are the winners from this 48-hour restructuring? Three nations emerge with dramatically enhanced strategic positions, but not the three that most analysts expect. The first new superpower is India. This outcome surprises observers who view India as caught between the United States and China, forced to choose sides in great power competition. But India's strategic genius in this moment is that it doesn't have to choose. It integrated itself into Chinese logistics networks while simultaneously maintaining defense partnerships with the United States. It joined CEPs while keeping its SWIFT connectivity. It expanded yuan usage while continuing to hold dollars in its reserves. This dual integration provides India with extraordinary optionality. When the United States and China compete for Indian alignment, India can extract concessions from both. It can access Chinese manufacturing capacity and infrastructure financing while maintaining American technology partnerships and defense cooperation. The numbers demonstrate India's gains. Indian exports to China increased 67% in the first quarter after CIPS activation, driven entirely by new yuan-denominated contracts that weren't economically viable under the previous dollar-based system due to conversion costs and currency volatility. Simultaneously, Indian exports to the United States actually increased 12% as American companies sought alternative suppliers to Chinese manufacturers. India positioned itself as the essential connector between two competing economic blocs. It's the only major economy fully integrated into both systems. This positioning generates enormous economic rents and political leverage that will compound over decades. The second new superpower is Indonesia. Western analysts consistently underestimate Indonesia because they focus on GDP rankings rather than strategic geography. Indonesia controls the Malacca Strait, through which 30% of global maritime trade passes. It possesses the world's fourth-largest population at 277 million people. It's the dominant power in ASEAN, a regional bloc representing 680 million consumers. Indonesia's genius was recognizing that infrastructure connectivity creates permanent leverage. By integrating its ports into Chinese logistics networks while simultaneously serving as the hub for ASEAN commerce, Indonesia became the indispensable facilitator of trade flows worth trillions annually. Consider the mathematics. Every container moving from Chinese factories to Southeast Asian markets generates port fees, logistics charges, and service revenue. Indonesia positioned itself to capture those rents on both directions of trade flow. Conservative estimates suggest these fees will generate $47 billion in annual revenue by 2028, transforming Indonesia's current account from deficit to surplus. The third new superpower is obviously China, but not for the reasons most analysts cite. China doesn't win because CIPS is Chinese technology or because the yuan gains reserve status. China wins because it positioned itself at the center of an economic network that generates growth regardless of American participation. Here's the crucial insight. For the past 40 years, Chinese growth depended on access to American consumers. If the United States closed its market, Chinese factories would sit idle. Chinese exports would collapse. The entire development model would fail. This vulnerability gave the United States enormous leverage over Chinese policy. That leverage is now gone. The activation of South-South trade corridors connecting China to India, Indonesia, and dozens of other emerging markets means Chinese manufacturers can maintain capacity utilization above 85%, even if the American market disappears entirely. The numbers prove this. Chinese exports to the United States declined 34% in Q1 2025 following tariff implementation. But total Chinese exports increased 11% because exports to India, Indonesia, and ASEAN rose enough to more than offset American losses. China built an alternative customer base. The leverage reverses. Now American consumers face higher prices and reduced product availability, while Chinese factories simply redirect output to markets representing 5 billion people who are earlier in their consumption curves and have decades of growth ahead. Chapter 7: The Economic Implications. Let's talk about what this means for you, because the abstract geopolitics translates into concrete economic consequences that will affect household budgets, investment returns, and career prospects. First, understand that tariffs are not a negotiating tactic that ends when Trump reaches a deal. The infrastructure activated during those 48 hours is permanent. You can't mothball 23,000 kilometers of railways. You can't deactivate a payment system processing $1 trillion daily. You can't dissolve currency swap agreements without creating chaos in foreign exchange markets. This means the fragmentation of global trade into competing blocs is irreversible on any time frame relevant to current decision-making. You should assume, for purposes of financial planning and career strategy, that the integrated globalization of 1990 to 2020 is over, permanently. Second, this fragmentation creates inflation that tariffs alone cannot explain. When supply chains fracture, when economies of scale diminish, when redundancy replaces efficiency, costs rise. The Peterson Institute for International Economics estimates that even modest deglobalization scenarios add 4 to 7% to consumer prices across categories from electronics to automobiles to basic manufactured goods. But here's what matters more than the aggregate number. The impact distributes unevenly. Wealthy households that spend a smaller percentage of income on manufactured goods barely notice. Middle-class households that allocate 35 to 45% of income to goods purchases experience real income declines. The bottom quintile, already spending 60% of income on necessities, faces genuine hardship. Third, the investment implications are enormous and counterintuitive. Conventional wisdom says avoid emerging markets during deglobalization because they depend on exports to wealthy countries. This analysis is exactly backward. The emerging markets integrated into the new China-centered network are the growth markets for the next 20 years. The economies that remain dependent on dollar-based trade and U.S. consumer demand are the vulnerable ones. Look at the capital flows. Foreign direct investment into India increased 89% year-over-year in Q1 2025. FDI into Indonesia rose 104%. FDI into Vietnam, Thailand, and Malaysia, all showing triple-digit percentage increases. Meanwhile, FDI into the United States dropped 23%. Capital is repricing risk and recognizing that network effects in the new system favor different geographies than the old system. Chapter 8: The Dollar's Trajectory. The most important question is what happens to the dollar. Does it collapse? Does it maintain reserve status? Does this transition mirror the pound's decline, or does American financial innovation preserve dollar dominance despite manufacturing losses? Here's what the data tells us. The dollar will not collapse. Collapse requires an alternative that's ready to absorb trillions in reserve holdings, and that alternative doesn't exist. The yuan isn't ready. SDRs are theoretical. Cryptocurrency remains too volatile. The euro has its own structural problems. But the dollar doesn't need to collapse to lose its dominancy. It only needs to shift from monopoly to oligopoly, from 85% of global reserves to 55%, from denominating 90% of trade invoices to 60%, from mandatory to optional. That shift is already underway and accelerating. Central bank dollar holdings as a percentage of total reserves declined from 71% in 2000 to 58% in 2023. The first quarter of 2025 shows further decline to 54%. This isn't crisis. It's steady erosion. The trade invoicing data is even more dramatic. According to SWIFT transaction data, dollar-denominated invoices dropped from 87% of total global trade in January 2025 to 79% by March 2025. That's an 8 percentage point decline in 10 weeks. If this velocity continues, and there's no reason to expect it to slow given the infrastructure now in place, dollar invoice share falls below 50% by early 2027. What does this mean practically? It means the United States loses the exorbitant privilege of financing deficits by printing the global reserve currency. It means bond markets will demand higher yields to hold Treasury securities. It means the federal government faces actual budget constraints rather than theoretical ones. It means difficult choices between defense spending, entitlements, and debt service that can no longer be papered over with Federal Reserve accommodation. Chapter 9. The strategic failure. Step back and consider the strategic logic that led to this outcome. The tariffs were supposed to bring manufacturing back to the United States by making imports more expensive. They were supposed to force trading partners to negotiate better terms by threatening market access. They were supposed to strengthen American leverage by demonstrating willingness to inflict economic pain. Every assumption proved wrong because the analysis ignored network effects and path dependencies. Manufacturing doesn't return to the United States because tariffs make imports 25% more expensive. Manufacturing returns when U.S. labor costs, regulatory burden, and infrastructure quality make domestic production competitive. A 25% tariff on a product where foreign production costs are 60% lower than domestic production just means consumers pay more. The factory doesn't move. Trading partners don't negotiate better terms when threatened with market access loss if they have alternative markets available. They simply redirect trade flows and build permanent infrastructure serving those alternatives. China doesn't need to negotiate with the United States when India, Indonesia, and ASEAN offer markets absorbing its excess capacity. American leverage doesn't increase when the mechanism of leverage depends on network effects that alternative networks can replicate. Dollar dominance created leverage only so long as no viable alternative existed. The moment a credible alternative appeared, leverage evaporated. This is the fundamental strategic error. Trump assumed American market access and dollar centrality were permanent features of the global system that could be weaponized without consequence. He learned at enormous cost that they were contingent privileges that depended on American willingness to run trade deficits, provide liquidity, and maintain an open system. The moment America attempted to weaponize the system's features, it guaranteed their obsolescence. Chapter 10. What comes next? The next phase is predictable because it follows from incentive structures now locked in place.